Understanding the common causes of surety claims requires a comprehensive exploration of the multifaceted factors that contribute to defaults and failures in contractual obligations. Suretyship, a practice with roots tracing back to ancient civilizations such as Mesopotamia and Rome, serves as a critical mechanism in modern commerce to mitigate risks associated with contractual agreements. The theoretical framework of suretyship is grounded in the principles of trust, risk assessment, and legal obligation, where a surety guarantees the performance of a principal to an obligé. At its core, a surety bond is a tripartite agreement involving the principal, the party obliged to perform, the obligé, the beneficiary of the obligation, and the surety, the guarantor of the principal's performance. The issuance of a surety bond involves rigorous underwriting processes, where the surety assesses the principal's capacity to fulfill contractual obligations. Despite these precautions, claims arise when the principal fails to meet the terms of the contract, prompting the obligé to seek recompense from the surety. The root causes of surety claims are diverse and often interrelated, necessitating a deep dive into each potential factor. Financial insolvency of the principal is a predominant cause, where mismanagement of funds, inadequate cash flow, or overextension on multiple projects leads to an inability to fulfill contractual duties. Studies, such as the one published in the Journal of Construction Engineering and Management, highlight that poor financial planning accounts for a significant proportion of contractor defaults. Project management deficiencies also contribute substantially to surety claims. Ineffective scheduling, resource misallocation, and failure to adhere to project timelines can result in breaches of contract. Theoretical models like the Critical Path Method, CPM, illustrate the importance of meticulous planning and monitoring of project activities to prevent delays and cost overruns. Moreover, the lack of skilled personnel or high staff turnover disrupts project continuity, further increasing the risk of default. External factors, including economic fluctuations, market volatility, and unforeseen events like natural disasters, play a crucial role in the emergence of surety claims. The global financial crisis of 2008, for instance, led to a surge in defaults due to tightened credit markets and decreased project funding, as discussed in economic analyses by institutions like the International Monetary Fund. Additionally, supply chain disruptions can cause material shortages or price escalations, impacting the principal's ability to deliver as promised. Legal and regulatory compliance failures are another significant cause. Non-adherence to building codes, safety regulations, or environmental laws can halt projects and lead to legal penalties, thereby impeding contract fulfillment. The interplay between suretyship and legal frameworks emphasizes the necessity for principals to maintain robust compliance mechanisms. Legal theories pertaining to contractual obligations and tort liabilities, explored in depth by legal scholars such as Arthur Corbin, provide insights into the complexities of these issues. Interdisciplinary connections reveal that organizational behavior and corporate governance also influence the likelihood of surety claims. A corporate culture that lacks ethical standards or fails to prioritize accountability can lead to decisions that compromise project integrity. Psychological theories on decision-making and ethical behavior, including Kohlberg's stages of moral development, shed light on how individual and collective actions within an organization impact contractual performance. Contemporary debates in the field focus on the effectiveness of current risk assessment models used by sureties. Critics argue that traditional financial metrics may not adequately capture the nuanced risks associated with complex projects. There is a growing interest in incorporating advanced analytics and artificial intelligence to enhance predictive capabilities. Research published in the Risk Management Journal suggests that machine learning algorithms can identify patterns and warning signs of potential defaults more accurately than conventional methods. Preventing future losses involves a multifaceted approach. Sureties are increasingly adopting proactive measures such as continuous monitoring of the principal's performance, providing technical assistance, and implementing early warning systems. The development of collaborative relationships between sureties, principals, and obligees fosters a more transparent and responsive environment. Practical applications of this approach are evident in the adoption of integrated project delivery methods, which promote shared risk and collective responsibility among all parties involved. From a theoretical standpoint, risk management frameworks like Enterprise Risk Management, ERM, offer comprehensive strategies to identify, assess, and mitigate risks associated with contractual obligations. Implementing ERM principles enables organizations to systematically address potential issues before they escalate into claims. Academic research, including studies from the Harvard Business Review, emphasizes the importance of embedding risk management into organizational culture and decision-making processes. Technological advancements also present opportunities and challenges in the realm of surety claims. The rise of digital platforms and blockchain technology introduces new modalities for contract execution and monitoring. Smart contracts, for instance, automate contractual obligations and can enhance transparency and efficiency. However, they also raise questions about legal enforceability and the role of sureties in a technologically evolving landscape, as discussed in legal analyses published in the Journal of Business and Technology Law. Globalization adds another layer of complexity. Cross-border projects involve diverse legal systems, cultural differences, and varying business practices, which can increase the risk of misunderstandings and contractual breaches. International standards and conventions, such as the United Nations Convention on Contracts for the International Sale of Goods, CISG, provide frameworks to navigate these challenges. The World Bank's involvement in global infrastructure projects often necessitates surety arrangements that comply with international best practices. Economic theories related to information asymmetry and moral hazard are relevant to understanding surety claims. The principal may have more information about potential risks than the surety, leading to underwriting challenges. Mechanisms to mitigate information gaps, such as thorough due diligence and requiring collateral, are essential components of risk management strategies. Scholarly work by economists like Joseph Stiglitz on asymmetric information provides valuable insights into these dynamics. In the realm of construction, which accounts for a significant portion of surety bonds, industry-specific factors come into play. The cyclical nature of the construction industry means that economic downturns can disproportionately affect contractors. Labor shortages, changes in regulatory requirements, and technological innovations like building information modeling. BIM. Impact project execution. Publications in the Construction Management and Economics Journal explore how these factors influence the likelihood of defaults and claims. Insurance principles intersect with suretyship, although the two are distinct in function and purpose. While insurance transfers risk, suretyship is a credit arrangement where the risk remains primarily with the principal. Understanding this distinction is crucial for stakeholders. Regulatory bodies like the National Association of Insurance Commissioners, NAIC, provide guidelines and standards that govern surety practices, ensuring the solvency and reliability of surety companies. Behavioral economics offers perspectives on why principals may take on excessive risks leading to defaults. Concepts like overconfidence bias and the optimism bias can result in underestimating project complexities or overcommitting resources. Addressing these cognitive biases through training and awareness programs can enhance decision-making processes. Research in behavioral finance, such as the works of Daniel Kahneman and Amos Tversky, elucidates these psychological factors. The role of governance structures cannot be understated. Effective corporate governance, characterized by strong oversight, transparent reporting, and accountability mechanisms, reduces the risk of defaults. The implementation of internal controls and compliance programs, as outlined in frameworks like the Committee of Sponsoring Organizations of the Treadway Commission, COSO, is instrumental in preventing failures that lead to surety claims. Environmental and social governance, ESG considerations, are increasingly influencing project execution and, by extension, surety claims. Projects that fail to address environmental impacts or social implications may face community opposition, legal challenges, or regulatory hurdles. Incorporating ESG criteria into project planning and execution aligns with sustainable development goals and can reduce the risk of claims. Scholarly articles in the Journal of Sustainable Finance and Investment discuss the integration of ESG factors in risk assessment. The legal landscape surrounding surety claims is complex, involving contract law, statutory regulations, and case law precedents. Jurisdictions may have specific statutes governing surety bonds, such as the Miller Act in the United States, which mandates performance and payment bonds for federal construction projects. Legal interpretations of contract clauses, obligations, and defenses in claims are continually evolving, necessitating ongoing legal expertise and adaptation. Dispute resolution mechanisms play a pivotal role when claims arise. Alternative dispute resolution, ADR methods like arbitration and mediation offer avenues to resolve conflicts without resorting to litigation, which can be costly and time-consuming. The effectiveness of ADR in surety claims is supported by studies in the International Journal of Law in the Built Environment, highlighting its potential to preserve business relationships and achieve mutually beneficial outcomes. Education and training are fundamental in preventing surety claims. Stakeholders, including principals, obligees, and sureties, benefit from a thorough understanding of contractual obligations, risk factors, and best practices. Professional organizations such as the Surety and Fidelity Association of America, SFAA, and the International Surety Association provide resources, guidelines, and certification programs to enhance industry competence. Emerging trends in project delivery models such as public-private partnerships, PPPs, introduce new dimensions to suretyship. PPPs involve collaboration between government entities and private sector companies to deliver public services or infrastructure. The allocation of risks and responsibilities in PPPs can be complex, affecting the nature and likelihood of surety claims. Research from the Journal of Project Finance examines the implications of PPP structures on surety arrangements. Cultural factors and ethical considerations also influence contractual performance. A strong ethical framework within an organization promotes integrity and adherence to commitments. Ethical theories, including deontological and consequentialist perspectives, provide a philosophical basis for understanding the importance of ethical conduct in business operations. Incorporating ethics training and codes of conduct can mitigate risks associated with unethical behavior leading to defaults. Technological tools for project management and monitoring are advancing rapidly. Software solutions offer real-time tracking of project progress, financial management, and compliance checks. The utilization of these tools enhances transparency and allows for early detection of potential issues. Studies in the Journal of Information Technology and Construction demonstrate the positive impact of technology adoption on project outcomes and risk reduction. Market dynamics, including competition levels and industry consolidation, affect the operating environment for principals. High competition can lead to aggressive bidding practices, where contractors submit low bids to secure projects, potentially compromising profitability and increasing default risk. An analysis of market behaviors in the Strategic Management Journal highlights the need for balanced bidding strategies that consider both market positioning and financial sustainability. Financial instruments and credit facilities available to principals influence their capacity to manage cash flow and invest in project resources. Access to lines of credit, factoring arrangements, and other financial products can alleviate liquidity constraints. However, reliance on debt financing also introduces additional risk factors. Financial management theories, such as the Modigliani-Miller theorem, provide insights into capital structure decisions and their implications for business stability. Supply chain management is a critical component in the successful execution of projects. Disruptions in the supply chain, whether due to geopolitical factors, trade policies, or logistical challenges, can impede project timelines and increase costs. Strategies to enhance supply chain resilience, such as diversification of suppliers and just-in-time inventory systems, are discussed in logistics and operations management literature, including the International Journal of Production Economics. Human resource management practices impact the performance and reliability of the principal's workforce. Investing in employee training, fostering a positive organizational culture, and implementing effective leadership practices contribute to higher productivity and commitment. Theories of organizational behavior, such as Maslow's hierarchy of needs and Hertzberg's two-factor theory, elucidate the motivational factors that drive employee performance. Risk transfer mechanisms, including subcontracting and insurance policies, are employed by principals to manage specific risks. However, over-reliance on subcontractors without adequate oversight can introduce new risks. Ensuring that subcontractors are competent, financially stable, and compliant with contractual obligations is essential. The principal-agent theory in economics examines the challenges associated with delegating responsibilities and aligning incentives between parties. Regulatory changes and shifts in policy can create an uncertain environment for contractual obligations. Staying abreast of legislative developments and engaging in policy advocacy through industry associations can help principals anticipate and adapt to regulatory shifts. Analyses in the Journal of Regulatory Economics explore the impact of regulatory frameworks on business operations and risk management. Environmental factors, including climate change and sustainability considerations, are increasingly relevant. Projects may face delays or additional costs due to extreme weather events or the need to implement environmentally friendly practices. Risk assessments now often include environmental impact analyses, and principals may need to invest in sustainable technologies or practices to meet regulatory and societal expectations. Economic indicators and forecasts provide context for market conditions that affect project viability. Monitoring trends in interest rates, inflation, and gross domestic product, GDP growth, helps principals and sureties make informed decisions. Macroeconomic theories and models, such as Keynesian economics, offer frameworks for understanding how economic cycles influence business activities. In the international context, currency fluctuations and exchange rate risks can impact the cost structure of projects involving imported materials or cross-border transactions. Financial hedging strategies and currency risk management practices are essential for principals operating in the global market. Literature in international finance, including the works of authors like Yoon and Resnick, provides guidance on managing foreign exchange risks. Technological innovation introduces both opportunities and risks. The adoption of new technologies can enhance efficiency and competitiveness, but may also involve learning curves and implementation challenges. The Technology Acceptance Model, TAM, explains how users come to accept and use new technologies, emphasizing the importance of perceived usefulness and ease of use. Demographic shifts and labor market trends affect the availability of skilled workers. An aging workforce or declining interest in certain trades can lead to labor shortages, affecting project execution. Workforce development initiatives and partnerships with educational institutions can help address these challenges. Studies in labor economics highlight the importance of human capital investment for organizational success. Reputation risk is a critical consideration. A history of defaults or claims can damage a principal's reputation, leading to difficulties in securing future projects or bonds. Reputation management strategies, including public relations efforts and demonstrating a commitment to quality and reliability, are essential. The concept of corporate reputation is explored in depth in management literature, such as the Corporate Reputation Review. Financial reporting and transparency are vital for maintaining the confidence of sureties and obligates. Accurate and timely financial statements allow for proper assessment of the principal's financial health. Adherence to accounting standards, such as Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS, ensures consistency and comparability of financial information. Crisis management and contingency planning are necessary to prepare for unexpected events. Developing comprehensive contingency plans allows principals to respond effectively to emergencies, minimizing disruptions and potential defaults. The field of crisis management, with contributions from scholars like Ian Mitroff, provides methodologies for identifying vulnerabilities and implementing response strategies. Legal doctrines related to force majeure and impossibility of performance can affect surety claims. Understanding the legal criteria for invoking these doctrines is essential for principals facing circumstances beyond their control. Legal analyses in contract law journals discuss the application of these concepts and their implications for contractual obligations. The integration of sustainability and corporate social responsibility, CSR, into business strategies reflects a growing recognition of their importance. Sustainable business practices can enhance long-term viability and reduce risks associated with environmental and social factors. CSR theories, such as Carroll's Pyramid of Corporate Social Responsibility, provide frameworks for understanding and implementing socially responsible initiatives. Data analytics and big data are transforming risk assessment processes. The ability to analyze large data sets allows sureties to identify trends and correlations that may not be evident through traditional methods. Predictive analytics can enhance underwriting decisions and monitoring practices. Research in the field of data science, including works published in the Journal of Big Data, highlights the potential of analytics in risk management. Communication practices between principals, sureties, and obligates are fundamental to preventing misunderstandings and ensuring alignment of expectations. Effective communication strategies involve clarity, transparency, and responsiveness. Communication theories, such as the Shannon-Weaver model, underscore the importance of addressing potential barriers to effective information exchange. In summary, understanding the common causes of surety claims involves a holistic examination of financial management, project execution, legal compliance, organizational behavior, market dynamics, technological advancements, and a host of other factors. By dissecting each element and exploring their interconnections, stakeholders can identify patterns and implement strategies to mitigate risks and prevent future losses. The collection and management of claims histories represent a critical facet in the insurance and risk management industries, serving as the backbone for informed decision-making, risk assessment, and strategic planning. Understanding the best practices for gathering, organizing, and maintaining accurate claims, data necessitates a deep exploration into the historical evolution of data management, the theoretical underpinnings of information systems, practical methodologies employed in the field, interdisciplinary connections with emerging technologies, and the contemporary debates surrounding data privacy and security. Historically, the collection of claims data has transitioned from rudimentary record-keeping methods to sophisticated digital systems. In the early days of insurance, data was manually recorded in ledgers, limiting the ability to analyze trends or predict future risks effectively. The advent of computing technology in the mid-20th century marked a significant turning point, enabling the digitization of records and the application of statistical models. Pioneering works like those of Claude Shannon on information theory laid the groundwork for modern data management practices, emphasizing the importance of data accuracy and integrity. The theoretical frameworks that underpin data collection and management are multifaceted, encompassing principles from information theory, database management, and data quality frameworks. The information lifecycle management, ILM theory, posits that data must be managed from its inception to its disposal, ensuring relevance and compliance at every stage. Database normalization, a concept introduced by Edgar F. Codd, is fundamental in organizing data to reduce redundancy and improve integrity within relational databases. Furthermore, the Data Quality Assessment Framework, DQAF, developed by the International Monetary Fund, provides a comprehensive approach to evaluating the quality of data, focusing on dimensions such as accuracy, completeness, consistency, timeliness, and relevance. Practically, best practices for gathering claims data begin with the establishment of standardized data collection processes. Implementing uniform data entry protocols ensures that information is captured consistently across the organization. Utilizing electronic data interchange, EDI systems, facilitates the seamless transfer of data between entities, reducing the likelihood of errors associated with manual data entry. Advanced data capture technologies such as optical character recognition, OCR, and intelligent document processing, IDP, enable the extraction of data from unstructured sources like paper documents or emails, enhancing the comprehensiveness of the data collected. Organizing claims data effectively requires robust database management systems, DBMS, capable of handling large volumes of data while ensuring scalability and performance. Relational databases have traditionally been the cornerstone of data management, but the rise of big data has led to the adoption of NoSQL databases and data lakes. These technologies accommodate unstructured data and support complex analytical queries. Metadata management is also crucial as it provides context to the data, facilitating easier retrieval and analysis. Implementing data cataloging tools helps in maintaining an inventory of data assets, promoting data discoverability and governance. Maintaining accurate claims data hinges on stringent data governance policies. Establishing a data governance framework involves defining data ownership, establishing data stewardship roles, and implementing data quality controls. The Data Management Body of Knowledge, DMBOK, published by the Data Management Association, DAMA, outlines best practices and principles for effective data governance. Regular data audits and validation processes are essential to identify and rectify discrepancies, ensuring the reliability of the data. Implementing data lineage tracking allows organizations to trace the origin and transformations of data, enhancing transparency and trust in the data assets. Interdisciplinary connections with fields such as data science, machine learning, and artificial intelligence are reshaping the management of claims histories. Predictive analytics and machine learning algorithms enable the identification of patterns and anomalies within claims data, supporting fraud detection and risk assessment. Techniques like cluster analysis and regression models are employed to uncover relationships between variables, providing deeper insights into claims trends. The integration of artificial intelligence in data management systems enhances automation and efficiency, as discussed in publications like the Journal of Big Data. Contemporary debates in the field revolve around data privacy, security, and ethical considerations. The implementation of regulations such as the General Data Protection Regulation, GDPR, in the European Union, and the California Consumer Privacy Act, CCPA, reflects the growing emphasis on protecting personal information. Organizations must navigate the complexities of compliance, balancing the need for comprehensive data collection with the obligation to safeguard individual privacy. Cybersecurity threats pose significant risks to the integrity and confidentiality of claims data. Best practices involve adopting robust security measures, including encryption, access controls, and intrusion detection systems, as outlined in frameworks like the National Institute of Standards and Technology, NIST, Cybersecurity Framework. Advanced and speculative insights consider the potential of blockchain technology and distributed ledger systems in managing claims histories. Blockchain offers immutable and transparent record keeping, reducing the risk of data tampering and enhancing trust among stakeholders. Smart contracts can automate claims processing, triggering payments based on predefined conditions. However, challenges such as scalability, interoperability, and regulatory acceptance remain subjects of ongoing research and discussion, as noted in studies published in the Journal of Blockchain Research. The role of cloud computing in data management cannot be overstated. Cloud-based data storage and processing solutions offer scalability, flexibility, and cost-effectiveness. Providers like Amazon Web Services, Microsoft Azure, and Google Cloud Platform offer services that support data warehousing, real-time analytics, and machine learning. Organizations must, however, address concerns related to data sovereignty and vendor lock-in. Hybrid cloud strategies, combining on-premises and cloud resources, are often adopted to balance control and scalability. Data standardization initiatives, such as the adoption of industry-specific data models and taxonomies, facilitate interoperability and data sharing among organizations. Standards like ACORD for the insurance industry provide guidelines for data formats and definitions, promoting consistency. The implementation of standardized data models supports initiatives like data pooling and benchmarking, enabling organizations to gain broader insights and improve industry practices. The human factor in data management is critical. Developing a data-centric culture within the organization emphasizes the importance of data quality and empowers employees to take ownership of data-related processes. Training and development programs enhance the data literacy of staff, enabling them to understand and utilize data effectively. Leadership commitment to data management initiatives is essential for allocating resources and setting strategic priorities. Emerging technologies such as the Internet of Things, IoT, are expanding the scope of data collection. IoT devices generate vast amounts of real-time data that can be integrated into claims histories, providing granular insights into events leading to claims. For example, telematics in auto insurance collects data on driving behavior, which can be used to assess risk more accurately. The integration of IoT data requires robust data ingestion and processing capabilities, as well as considerations around data privacy and security. Ethical considerations in data management are gaining prominence. The concept of data ethics involves principles related to fairness, accountability, and transparency in data practices. Ethical frameworks guide organizations in making decisions about data collection methods, usage, and sharing. Issues such as algorithmic bias in predictive models necessitate careful evaluation to prevent unintended discrimination. as discussed in works like Weapons of Math Destruction by Cathy O'Neil. The utilization of data visualization and business intelligence tools enhances the ability to interpret and communicate insights derived from claims data. Tools like Tableau, Power BI, and QLiC View enable the creation of interactive dashboards and reports, facilitating data-driven decision-making. Effective data visualization adheres to principles outlined by experts like Edward Tufte, focusing on clarity, accuracy, and efficiency in presenting information. Regulatory compliance extends beyond data privacy laws to include industry-specific regulations. In the insurance sector, regulations may mandate the retention of claims data for specified periods and require reporting to regulatory bodies. Compliance with standards such as the Sarbanes-Oxley Act, SOX, for financial transparency, and the Health Insurance Portability and Accountability Act, HIPAA, for health data privacy, necessitates rigorous data management practices. Collaboration with external entities, such as reinsurers, brokers, and regulatory agencies, often involves the exchange of claims data. Establishing secure data sharing protocols and agreements ensures that data is transmitted and used appropriately. Technologies like secure APIs and data exchange platforms support efficient and secure collaboration. Data archiving and retention policies are essential components of data management. Determining the appropriate duration for retaining claims, data involves balancing legal requirements, business needs, and storage costs. Implementing tiered storage solutions allows organizations to store frequently accessed data on high-performance media, while archiving older data on cost-effective storage. Policies must also address the eventual disposal of data, ensuring that it is destroyed securely to prevent unauthorized access. Disaster recovery and business continuity planning are critical for preserving access to claims data in the event of system failures or catastrophic events. Regular backups, redundant systems, and failover mechanisms are implemented to minimize downtime and data loss. Adherence to best practices outlined in standards like ISO 22301 for business continuity management enhances organizational resilience. The integration of master data management, MDM practices, ensures that key data elements are consistent and accurate across the organization. MDM involves defining data domains, establishing data hierarchies, and implementing processes for data synchronization. This practice reduces data silos and supports a single source of truth for critical data, enhancing the reliability of claims histories. Data quality management is an ongoing process that involves monitoring and improving data over time. Techniques such as data profiling, cleansing, and enrichment are employed to identify and correct errors. Implementing data quality metrics and key performance indicators, KPIs, allows organizations to measure the effectiveness of their data management efforts. The role of data stewardship is vital in overseeing data assets. Data stewards are responsible for ensuring data quality, defining data standards, and facilitating communication between business units and IT departments. Establishing clear roles and responsibilities supports accountability and promotes adherence to data governance policies. Artificial intelligence and machine learning models require high-quality data to produce accurate results. The concept of garbage in, garbage out, GGO, underscores the importance of data quality in predictive analytics. Data scientists and analysts must work closely with data management teams to ensure that data used in models is accurate, relevant, and free from bias. Data monetization is an emerging trend where organizations leverage their data assets to generate new revenue streams. This may involve sharing aggregated and anonymized claims data with third parties for research or industry benchmarking. Ethical and legal considerations must be addressed to ensure compliance with privacy laws and contractual obligations. The concept of data democratization advocates for broad access to data within the organization, empowering employees at all levels to utilize data in their roles. Implementing self-service analytics platforms supports this approach, but requires robust data governance to prevent misuse and ensure data security. Cloud-native data warehouses and data platforms are redefining how organizations manage data. Services like Snowflake and Databricks offer scalable, flexible environments for storing and processing large data sets. Leveraging these platforms enables organizations to handle the growing volume and variety of claims data efficiently. In the realm of cybersecurity, The rise of sophisticated cyber threats necessitates advanced security measures. Implementing multi-factor authentication, intrusion prevention systems, and conducting regular security assessments are critical components of a comprehensive security strategy. Collaborations with cybersecurity experts and participation in information-sharing networks enhance the organization's ability to detect and respond to threats. Data anonymization and pseudonymization techniques are employed to protect personal information within claims data. These practices involve modifying data to prevent the identification of individuals, supporting compliance with privacy regulations while enabling data analysis. Techniques such as tokenization and data masking are utilized, as detailed in the International Journal of Information Security. The use of metadata and data lineage tools supports transparency and traceability in data management. Metadata provides information about the data, such as source, creation date, and modifications, aiding in data governance and compliance efforts. Data lineage tools track the flow of data through systems and processes, facilitating impact analysis and auditing. The adoption of Agile and DevOps methodologies in IT operations influences data management practices. Agile approaches emphasize iterative development and flexibility, which can enhance the responsiveness of data management initiatives. DevOps promotes collaboration between development and operations teams, streamlining the deployment of data solutions. Data ethics boards and committees are being established within organizations to oversee ethical considerations related to data practices. These bodies provide guidance on issues such as consent, data usage policies, and the ethical implications of data-driven decisions. Engaging stakeholders from diverse backgrounds ensures that multiple perspectives are considered. International data transfer regulations, such as the Schrems II decision by the European Court of Justice, impact how organizations handle cross-border data flows. Ensuring compliance with international laws requires a thorough understanding of legal requirements and may involve implementing standard contractual clauses or other legal mechanisms. Continuous learning and staying abreast of technological advancements are essential for professionals involved in data management. Participation in professional networks, attending conferences, and pursuing certifications support ongoing development. Organizations like the International Association for Information and Data Quality, IAIDQ, offer resources and certification programs. In conclusion, the effective collection and management of claims histories are integral to the success of organizations in the insurance and risk management sectors. By adhering to best practices, leveraging emerging technologies, and addressing ethical and regulatory challenges, organizations can enhance data quality, support strategic decision-making, and maintain a competitive edge in a data-driven world. The application of advanced statistical techniques to claims analysis represents a critical intersection of actuarial science, data analytics, and risk management. This domain has evolved significantly over time, reflecting advancements in statistical methodologies and the increasing availability of granular data. Understanding how to apply statistical models to uncover trends and correlations in claims data is essential for insurers, actuaries, and risk analysts seeking to optimize pricing strategies, reserve estimations, and fraud detection mechanisms. Historically, the use of statistics in insurance dates back to the 17th century, with the work of mathematicians like Blaise Pascal and Pierre de Fermat laying the groundwork for probability theory. The development of life tables by Edmund Halley in the late 17th century enabled the calculation of life insurance premiums based on mortality rates. Throughout the 20th century, the actuarial profession increasingly incorporated statistical methods to assess risk and predict future claims. The advent of computers and statistical software in the latter half of the century revolutionized the field, allowing for more complex models and the analysis of larger data sets. The theoretical frameworks underlying claims analysis are rooted in probability theory, statistical inference, and stochastic processes. Fundamental concepts such as the frequency and severity of claims are modeled using probability distributions. The Poisson distribution is often employed to model the number of claims occurring within a fixed period, assuming that events occur independently and at a constant average rate. For modeling claim severity, distributions like the exponential, gamma, or log normal are utilized, capturing the variability in claim sizes. One of the foundational models in claims analysis is the collective risk model, which combines the frequency and severity distributions to assess the aggregate claims over a specified period. The model assumes that the total claim amount is the sum of individual claims, each independent of the others. This framework facilitates the calculation of probabilities related to total losses exceeding certain thresholds, which is crucial for setting reserves and determining reinsurance needs. In practical applications, actuaries and analysts employ generalized linear models, GLMs, to explore relationships between claims experience and risk factors. GLMs extend traditional linear regression by allowing for response variables that have error distribution models other than a normal distribution, accommodating distributions like Poisson, binomial, or gamma. This flexibility enables the modeling of claim counts and amounts in a manner consistent with their statistical properties. The work of Nelder and Wedderburn in 1972 on GLMs has been instrumental in advancing actuarial modeling techniques. Credibility theory is another key component in claims analysis, providing a framework for combining past experience with broader industry data to estimate future claims. Buhlmann credibility models assign weights to individual and collective experience based on their respective variances, optimizing the balance between specific and general information. This approach enhances the accuracy of premium calculations and reserve estimations. Advanced statistical techniques involve the use of multivariate analysis to uncover correlations between multiple variables influencing claims. Techniques such as principal component analysis, PCA, and factor analysis reduce the dimensionality of data, identifying underlying factors that explain the variability in claims data. Cluster analysis groups similar policyholders or claims, facilitating targeted strategies for underwriting or fraud detection. Hierarchical clustering and K-means clustering are common methods used in this context. Time series analysis is employed to model and forecast claims over time, accounting for trends, seasonality, and cyclicality. Autoregressive integrated moving average, ARIMA models, introduced by Box and Jenkins in the 1970s, are widely used for forecasting purposes. These models capture the autocorrelation in data, enabling more accurate predictions of future claim frequencies or severities. Incorporating external variables into time series models, known as exogenous variables, allows analysts to assess the impact of economic factors or regulatory changes on claims experience. Survival analysis, or time-to-event analysis, is particularly relevant in claims related to long-term policies or those with delayed reporting of claims, known as incurred but not reported, IBNR claims. The Cox Proportional Hazards Model, developed by Sir David Cox in 1972, is a semi-parametric model that estimates the hazard rate of an event occurring, accounting for covariates. This method is valuable in estimating the timing and likelihood of claims emerging over time. Bayesian statistics offers a probabilistic approach to claims analysis, incorporating prior beliefs and updating them with observed data. Bayesian models are especially useful when dealing with limited data or when integrating expert judgment into the analysis. Markov chain Monte Carlo, MCMC methods, facilitate the computational aspects of Bayesian inference, allowing for the estimation of complex posterior distributions. The Bayesian approach aligns with the stochastic nature of insurance risks and supports more nuanced decision-making. In recent years, machine learning algorithms have been increasingly adopted in claims analysis, bridging the gap between statistical methods and artificial intelligence. Techniques such as decision trees, random forests, and gradient boosting machines enhance predictive accuracy by capturing nonlinear relationships and interactions between variables. Neural networks, including deep learning models, have been applied to recognize complex patterns in high-dimensional data. Support vector machines, SVM, and K-nearest neighbors, KNN, are also utilized for classification tasks, such as identifying fraudulent claims. Interdisciplinary connections emerge as statistical techniques intersect with fields like econometrics, computational statistics, and data science. Econometric models, such as panel data analysis, account for both cross-sectional and time series variations, providing insights into how economic variables influence claims. Computational statistics leverages algorithms and computational power to handle large data sets, essential in processing vast amounts of claims data. Data science integrates statistical modeling with data engineering and domain expertise, promoting a holistic approach to claims analysis. Contemporary debates in the field revolve around the interpretability of complex models versus their predictive power. While machine learning models often yield higher predictive accuracy, they may lack transparency, making it challenging to understand the drivers behind predictions. This black box nature raises concerns in regulated industries like insurance, where explainability is crucial for compliance and ethical considerations. The trade-off between model complexity and interpretability is an ongoing discussion among practitioners and researchers. Another area of debate is the ethical implications of using advanced statistical techniques, particularly concerning fairness and bias. Models may inadvertently perpetuate historical biases present in the data, leading to discriminatory outcomes. For instance, using certain demographic variables in pricing or claims handling can raise legal and ethical issues. Regulatory bodies emphasize the importance of fairness and non-discrimination, prompting the development of algorithms that promote equitable treatment. Emerging trends in claims analysis involve the integration of real-time data and telematics. The Internet of Things, IoT devices, generate continuous streams of data, enabling dynamic risk assessment and personalized pricing. For example, in auto insurance, telematics data on driving behavior can inform risk models more accurately than traditional factors. Statistical techniques must adapt to handle streaming data and incorporate methods like online learning algorithms that update models in real time. Spatial statistics is gaining prominence in analyzing claims data with geographic components. Techniques such as crying and spatial autocorrelation assess how location influences claims experience. This is particularly relevant for risks affected by environmental factors, such as natural disasters in property insurance. Geographic Information Systems, GIS, integrate spatial data with statistical models, enhancing the ability to visualize and analyze geographic trends. Catastrophe modeling is a specialized area that employs advanced statistical and mathematical techniques to estimate losses from extreme events like hurricanes, earthquakes, or pandemics. Models incorporate probabilistic assessments of event frequencies and severities, often using Monte Carlo simulations to generate a range of possible outcomes. These models support insurers in setting appropriate premiums, reserves, and reinsurance arrangements. The work of Howard Kunreuther and others in disaster risk management provides foundational insights into catastrophe modeling. Copula models are utilized to model dependencies between multiple risk factors or lines of business. Copulas allow analysts to construct multivariate distributions by specifying marginal distributions and a dependent structure separately. This is particularly useful when modeling joint occurrences of claims across different portfolios, capturing tail dependencies that are critical in extreme loss scenarios. Extreme value theory, EVT, focuses on modeling the tails of distributions, which is essential for understanding the risk of rare but severe claims. EVT provides statistical methods for estimating the probability and impact of extreme losses, supporting risk management and capital allocation decisions. The peaks over threshold, POT approach, and the generalized Pareto distribution, GPD, are commonly used in EVT applications within insurance. The application of statistical learning theory, as formalized by Vladimir Vapnik, underpins many machine learning techniques used in claims analysis. This theory addresses the problem of function estimation from data, providing bounds on the generalization error of models. Understanding the theoretical limits of predictive models aids in selecting appropriate techniques and assessing their reliability. Model validation and backtesting are critical components of the modeling process. Validating models ensures that they perform adequately on unseen data and that their assumptions hold true. Techniques such as cross-validation, out-of-sample testing, and the use of holdout datasets are standard practices. Statistical tests, including the likelihood ratio test and the Kolmogorov-Smirnov test, assess the goodness of fit and compare alternative models. Regulatory frameworks, such as Solvency II in Europe and the risk-based capital, RBC requirements in the United States, influence how insurers model and report risks. These regulations emphasize the use of internal models for capital adequacy assessment, requiring robust statistical methods and thorough documentation. Compliance with regulatory standards necessitates transparency in modeling approaches and adherence to prescribed methodologies. The role of Actuarial Standards of Practice, ASOPs, guides professionals in applying statistical techniques ethically and effectively. ASOPs provide principles for selecting models, handling data, and communicating results. Professional bodies like the Society of Actuaries, SOA, and the Casualty Actuarial Society, CAS, offer guidelines and continuing education to support practitioners in staying abreast of advancements and best practices. Incorporating external data sources enhances the richness of claims analysis. Macroeconomic indicators, weather data, and social media sentiment can provide additional explanatory power. For example, integrating economic cycles into models helps in understanding how recessions or booms affect claim frequencies. However, the use of external data introduces challenges related to data quality, relevance, and integration. The application of natural language processing, NLP techniques, allows for the analysis of unstructured data, such as claim adjuster notes or customer communications. Text mining and sentiment analysis extract valuable insights from textual data, identifying patterns related to claim severity or potential fraud. NLP models, including topic modeling and named entity recognition, expand the analytical capabilities beyond structured numerical data. Advancements in computational power and software have democratized access to advanced statistical techniques. Open-source programming languages like R and Python offer extensive libraries for statistical modeling and machine learning. Packages such as GLM in R or scikit-learn in Python provide tools for implementing complex models. The accessibility of these tools supports innovation and experimentation in claims analysis. Educational initiatives and research contribute to the continuous development of statistical methods in insurance. Academic journals like the Astin Bulletin and Insurance, Mathematics and Economics publish research on actuarial science and risk theory. Collaborations between academia and industry foster the translation of theoretical advancements into practical applications. In the realm of speculative insights, quantum computing presents a frontier that could revolutionize data processing capabilities. Quantum algorithms have the potential to solve optimization problems and process large data sets more efficiently than classical computers. While still in nascent stages, research into quantum machine learning explores how these technologies could impact statistical modeling in insurance. The globalization of insurance markets introduces complexities related to differing regulatory environments, cultural factors, and risk exposures. Statistical models must be adapted to account for regional variations in data quality and availability. Cross-border data analysis requires harmonization of data definitions and consideration of legal constraints on data sharing. Ethical considerations extend to the responsible use of data and models. The concept of algorithmic accountability emphasizes the need for transparency in how models make decisions and the potential impacts on stakeholders. Organizations are encouraged to implement governance structures that oversee model development and deployment, ensuring alignment with ethical standards and societal values. Incorporating behavioral economics into claims analysis recognizes that human behavior often deviates from rational models. Concepts like moral hazard and adverse selection are central to insurance economics. Statistical models that integrate behavioral factors can better predict claims experience and inform strategies to mitigate undesirable behaviors. Climate change introduces new challenges for claims analysis, particularly in property and casualty insurance. Statistical models must account for changing risk profiles due to increased frequency and severity of natural disasters. Scenario analysis and stress testing are employed to assess the potential impacts of climate-related risks on portfolios. Data privacy regulations, such as the General Data Protection Regulation, GDPR, impact the collection and use of personal data in claims analysis. Compliance requires careful consideration of data processing activities, consent mechanisms, and data minimization principles. Anonymization and pseudonymization techniques are applied to protect individual privacy while enabling data analysis. Simulation methods, including Monte Carlo simulation, are used extensively in risk modeling to assess the distribution of possible outcomes. By generating a large number of random scenarios based on probabilistic models, analysts can estimate the likelihood of extreme losses and evaluate the effectiveness of risk mitigation strategies. Game theory offers insights into strategic interactions between insurers and policyholders, particularly in the context of claims fraud. Modeling the incentives and payoffs for fraudulent behavior informs the design of detection systems and deterrence mechanisms. Concepts like Nash equilibrium and signaling games are relevant in this analysis. The integration of insurance analytics platforms and big data technologies supports the processing and analysis of vast amounts of claims data. Distributed computing frameworks like Apache Hadoop and Apache Spark enable parallel processing, handling data that exceeds the capacity of traditional systems. This technological infrastructure is essential for implementing advanced statistical techniques at scale. Cultural and organizational factors influence the adoption of advanced statistical methods within insurance companies. Change management practices facilitate the transition to data-driven decision-making. Leadership commitment, employee training, and fostering a culture of innovation are critical components of successful implementation. In summary, the application of advanced statistical techniques to claims analysis is a multifaceted endeavor that draws upon a rich history of mathematical development, theoretical frameworks, and practical methodologies. It encompasses a wide array of statistical models and computational tools designed to uncover trends and correlations in claims data, ultimately enhancing risk assessment, pricing strategies, and operational efficiency within the insurance industry. Identifying early warning signs and red flags is a fundamental aspect of risk management, particularly within the insurance and financial sectors. The ability to detect potential risks before they materialize into claims not only safeguards the financial stability of organizations, but also enhances their capacity to provide reliable services to clients. Historically, the practice of risk detection has its roots in the early commercial ventures of maritime trade, where merchants and insurers sought methods to anticipate and mitigate losses from shipwrecks or piracy. The development of actuarial science in the 17th and 18th centuries, marked by contributions from mathematicians like Blaise Pascal and Edmund Halley, laid the groundwork for systematic risk assessment and the identification of risk indicators. The theoretical frameworks underpinning the detection of early warning signs draw from various disciplines, including probability theory, behavioral economics, and systems theory. Risk assessment models, such as the Risk Management Framework, RMF, and the Enterprise Risk Management, ERM model, provide structured approaches to identifying, analyzing, and responding to potential risks. The RMF, for instance, emphasizes a continuous process of risk identification, assessment, mitigation, and monitoring, as articulated in standards like ISO 31000. Behavioral economics contributes insights into how cognitive biases and irrational behaviors can signal underlying risks as explored in Daniel Kahneman's seminal work, Thinking Fast and Slow. Practical methods for detecting potential risks encompass a range of quantitative and qualitative techniques. Quantitative approaches involve statistical analysis of key performance indicators, KPIs, and financial metrics to identify anomalies or trends that deviate from expected patterns. For example, ratio analysis can reveal deteriorating financial health, with ratios such as the current ratio or debt-to-equity ratio indicating liquidity or solvency issues. Qualitative methods include conducting thorough due diligence, engaging in regular communication with clients or partners, and observing changes in management behavior or organizational culture. Tools like the Failure Mode and Effects Analysis, FMEA, and the Hazard and Operability Study, HAZOP, are employed in industries like engineering and manufacturing to anticipate potential points of failure. Interdisciplinary connections enhance the efficacy of risk detection. Psychology provides an understanding of how stress or ethical lapses in leadership can precede organizational failures. Sociological theories examine how group dynamics and organizational structures contribute to risk propagation. Data science and machine learning offer advanced analytics capabilities, enabling the processing of vast data sets to identify subtle patterns indicative of emerging risks. Techniques such as anomaly detection algorithms, neural networks, and natural language processing can analyze unstructured data sources, including social media and news feeds, to uncover early signs of reputational risks or market shifts. Contemporary debates in risk detection focus on the balance between technological solutions and human judgment. While artificial intelligence, AI, and predictive analytics offer powerful tools for risk identification, concerns arise regarding algorithmic transparency and the potential for over-reliance on automated systems. The black box nature of some AI models challenges the interpretability of results, leading to calls for explainable AI, XAI frameworks. Ethical considerations also emerge, particularly in relation to data privacy and the use of personal information in risk assessments. Regulations like the General Data Protection Regulation, GDPR, in the European Union impose strict guidelines on data usage, necessitating careful navigation by organizations. Transitioning to the integration of claims data into underwriting criteria, this practice represents a critical evolution in the insurance industry, enhancing the precision and fairness of underwriting decisions. Historically, underwriting relied heavily on actuarial tables and generalized risk categories, often resulting in broad classifications that did not account for individual risk profiles. The advancement of data collection and analytics has enabled underwriters to incorporate granular historical claims data, refining risk assessments and pricing strategies. The theoretical underpinnings of underwriting draw from actuarial science, statistics, and financial economics. Actuarial models assess the probability of future claims based on historical data, applying probability distributions and credibility theory to estimate expected losses. The law of large numbers and the central limit theorem provide statistical justification for using aggregated claims data to predict future events. Financial economics introduces concepts like risk pooling and diversification, as articulated in Harry Markowitz's modern portfolio theory, which, while originally applied to investment portfolios, offers insights into managing insurance risk portfolios. Practically, integrating historical claims insights into underwriting guidelines involves several steps. Data acquisition is the first critical phase, requiring the collection of accurate and comprehensive claims data. Data must be cleaned and pre-processed to address issues such as missing values, outliers, and inconsistencies. Advanced analytics techniques are then applied, including predictive modeling, segmentation analysis, and multivariate regression. Predictive models, such as generalized linear models, GLMs, and machine learning algorithms, identify risk factors and their relative importance. For example, in auto insurance, variables like driving history, vehicle type, and geographic location are analyzed to predict the likelihood of future claims. Underwriting guidelines are updated based on the insights derived from claims analysis. Risk factors identified through statistical models inform the development of underwriting rules and rating factors. This process ensures that premiums are commensurate with the risk presented by each policyholder, promoting fairness and financial stability. The integration of claims data also supports the identification of emerging risk trends, enabling underwriters to adjust criteria proactively. For instance, an increase in claims related to cyber incidents may prompt the revision of underwriting guidelines for cyber insurance policies. Interdisciplinary connections enrich the integration process. Behavioral economics offers perspectives on policyholder behavior, highlighting factors like moral hazard and adverse selection. Understanding these behaviors aids in designing underwriting criteria that mitigate such risks. Data science and information technology play pivotal roles in managing and analyzing large data sets. The use of big data technologies and cloud computing facilitates the processing of high-volume claims data, while data visualization tools enhance the interpretability of analytical results. Contemporary debates in underwriting revolve around the use of non-traditional data sources and the ethical implications thereof. The inclusion of data from social media, credit scores, or telematics raises questions about privacy, discrimination, and the potential for data misuse. Regulatory bodies scrutinize the use of such data, with legislation like the Fair Credit Reporting Act, FCRA, in the United States governing the use of consumer information. The insurance industry must navigate these regulatory landscapes while leveraging data to improve underwriting accuracy. Furthermore, the advent of AI and machine learning in underwriting introduces challenges related to transparency and accountability. Models like deep neural networks offer enhanced predictive capabilities, but often lack interpretability. The concept of algorithmic bias is of particular concern, as models trained on historical data may perpetuate existing disparities. Industry standards and regulatory guidelines emphasize the need for explainable models and the avoidance of discriminatory practices. Speculative insights consider the future of underwriting in the context of technological advancements. The potential for real-time underwriting, enabled by IoT devices and continuous data streams, suggests a shift towards dynamic risk assessment. Wearable technology, for instance, could provide real-time health data for life insurance underwriting, allowing for personalized premiums that reflect current risk levels. Blockchain technology offers possibilities for secure, transparent data sharing between insurers, reinsurers, and policyholders, enhancing trust and efficiency in the underwriting process. The integration of environmental, social, and governance (ESG) factors into underwriting criteria reflects a growing recognition of the broader impacts of insurance practices. Insurers are increasingly considering the ESG profiles of clients in underwriting decisions, aligning with sustainable finance principles. This trend is supported by frameworks like the Principles for Sustainable Insurance, PSI, established by the United Nations Environment Programme Finance Initiative, UNEP-FI. Incorporating ESG factors requires the analysis of additional data sources and the development of new risk assessment models. In terms of practical applications, case studies illustrate the benefits of integrating claims data into underwriting. For example, a property insurer may analyze historical claims related to natural disasters, identifying geographic areas with higher risk profiles. By incorporating this data into underwriting guidelines, the insurer can adjust premiums or coverage terms accordingly, enhancing risk management. Similarly, health insurers use claims data to identify prevalent health issues within certain demographics, informing underwriting criteria and wellness programs. From an operational perspective, the integration process necessitates collaboration between underwriters, actuaries, data scientists, and IT professionals. Establishing data governance frameworks ensures data quality, security, and compliance with regulatory requirements. Training and development programs enhance the analytical capabilities of underwriting teams, promoting a data-driven culture. In the context of identifying early warning signs and integrating claims data, there is a convergence of objectives. Both aim to enhance risk assessment and decision-making processes. Early detection of risks informs underwriting criteria, while effective underwriting reduces the likelihood of adverse claims experiences. This symbiotic relationship underscores the importance of holistic risk management strategies. Advanced statistical techniques, as discussed in prior lectures, play a critical role in both domains. Techniques like logistic regression, decision trees, and clustering algorithms support the identification of risk indicators and the segmentation of policyholders. Predictive analytics models forecast future claims, enabling proactive adjustments to underwriting guidelines. Machine learning algorithms trained on historical data can detect patterns that may elude traditional analysis, enhancing the detection of early warning signs. Moreover, the integration of claims data into underwriting aligns with the shift towards personalized insurance products. Usage-based insurance models, such as pay-as-you-drive policies, rely on continuous data collection and real-time risk assessment. This approach necessitates sophisticated data analytics capabilities and flexible underwriting frameworks. The interplay between regulatory developments and industry practices is a critical consideration. Regulatory bodies increasingly mandate the use of data-driven risk assessments to ensure solvency and consumer protection. Compliance with regulations like Solvency II in the European Union or the National Association of Insurance Commissioners, NAIC, guidelines in the United States requires robust risk modeling and reporting mechanisms. Ethical considerations permeate both the detection of early warning signs and the integration of claims data. Ensuring that risk assessments and underwriting practices are fair, transparent, and non-discriminatory is paramount. Organizations must implement ethical guidelines and oversight mechanisms to address potential biases and uphold standards of integrity. In conclusion, the identification of early warning signs and the integration of claims data into underwriting criteria are integral components of modern risk management and insurance practices. They represent the convergence of historical evolution, theoretical advancements, practical methodologies, and interdisciplinary collaboration, all aimed at enhancing the resilience and effectiveness of financial institutions in a complex and dynamic environment. Integrating claims data into underwriting criteria represents a transformative approach in the insurance industry, enhancing the precision of risk assessment and pricing strategies. Historically, underwriting has been central to insurance operations since the emergence of risk-sharing practices in ancient civilizations. But it was during the 17th century at Lloyd's Coffee House in London that underwriting began to formalize. Merchants and underwriters would meet to discuss maritime ventures, with underwriters assessing risks and setting premiums based on limited information and personal judgment. Over time, the accumulation of data and the development of actuarial science allowed for more systematic approaches, yet the integration of historical claims data into underwriting guidelines marks a significant evolution, leveraging empirical evidence to inform underwriting decisions more effectively. The theoretical framework underpinning this integration is grounded in actuarial science, statistics, and risk management principles. Actuarial science applies mathematical and statistical methods to assess risk in insurance, finance, and other industries. The law of large numbers, a fundamental principle in probability theory, asserts that as the number of exposures increases, the actual loss experience will converge towards the expected loss. This principle justifies the use of historical claims data to predict future losses. Additionally, the expected value principle and the variance principle provide methods for calculating premiums based on the expected claims cost and the variability of those claims, respectively. Risk management theories, such as enterprise risk management, ERM, emphasize a holistic approach to identifying, assessing, and managing risks across an organization. ERM frameworks advocate for the use of data analytics and historical insights to inform strategic decisions, aligning with the integration of claims data into underwriting criteria. Moreover, behavioral economics introduces concepts like moral hazard and adverse selection, highlighting how policyholder behavior can influence risk and the importance of incorporating behavioral data into underwriting models. Practically, the effective incorporation of historical claims insights into underwriting guidelines involves several key steps. 1. Data collection and quality assurance. Collecting comprehensive and accurate claims data is foundational. This includes detailed information on claim types, causes, amounts, policyholder demographics, and circumstances surrounding each claim. Data quality assurance processes, such as data cleansing, validation, and normalization, ensure that the data is reliable for analysis. 2. Data management and storage. Robust data management systems, such as data warehouses and cloud-based platforms, facilitate the storage and retrieval of large data sets. Implementing data governance frameworks ensures data integrity, security, and compliance with regulations like the General Data Protection Regulation, GDPR. 3. Statistical analysis and modeling. Advanced statistical techniques are applied to identify patterns and correlations within the claims data. Generalized linear models, GLMs, as introduced by Nelder and Wedderburn, are commonly used in insurance modeling due to their flexibility in handling different types of data distributions. Machine learning algorithms, such as decision trees, random forests, and gradient boosting machines, can capture complex nonlinear relationships between variables. 4. Risk factor, identification. Through analysis, underwriters identify key risk factors that significantly influence claims frequency and severity. For instance, in property insurance, factors like building age, construction materials, and geographic location may be significant predictors of claims related to fire or natural disasters. 5. Underwriting guideline development. The insights gained inform the development or refinement of underwriting guidelines. These guidelines specify the criteria for accepting risks, setting premiums, and determining policy terms. Incorporating empirical evidence ensures that underwriting decisions are data-driven and aligned with the organization's risk appetite. 6. Continuous monitoring and feedback loops. Establishing mechanisms for ongoing monitoring of claims experience allows underwriters to adjust guidelines proactively. Feedback loops ensure that the underwriting process remains responsive to emerging trends and changes in the risk landscape. Interdisciplinary connections enhance the effectiveness of integrating claims data into underwriting. Data science contributes methodologies for handling big data, such as distributed computing and parallel processing, enabling the analysis of vast data sets. Econometrics provides models for understanding the impact of economic variables on insurance claims, such as the relationship between unemployment rates and property crime claims. Psychology and sociology offer insights into human behavior and societal trends that may affect risk profiles, such as shifts in consumer behavior or the impact of social networks on fraud. Contemporary debates focus on ethical considerations and regulatory compliance. The use of big data analytics raises concerns about privacy and potential discrimination. For example, using personal data like credit scores or social media activity in underwriting may inadvertently lead to unfair treatment of certain groups. Regulatory bodies, such as the National Association of Insurance Commissioners, NAIC, in the United States, provide guidelines to prevent discriminatory practices, emphasizing the need for transparency and fairness in underwriting. Moreover, the rise of algorithmic underwriting introduces challenges related to model interpretability and accountability. Complex machine learning models may act as black boxes, making it difficult for underwriters to understand how inputs are transformed into outputs. This lack of transparency can hinder the ability to explain underwriting decisions to regulators or policyholders. Explainable AI, XAI, seeks to address this issue by developing models that provide clear, interpretable explanations of their decision-making processes. Speculative insights suggest that the future of underwriting will increasingly rely on real-time data and dynamic models. The Internet of Things, IoT, enables continuous data collection from devices such as telematics in vehicles or smart home sensors. This real-time data can feed into underwriting models, allowing for ongoing risk assessment and personalized pricing. Blockchain technology presents opportunities for secure, decentralized data sharing, potentially streamlining the underwriting process and enhancing trust among stakeholders. Practical applications of integrating claims data into underwriting are evident across various insurance lines. Auto insurance. Insurers use historical claims data to refine risk models based on driver behavior, vehicle characteristics, and environmental factors. Telematics data provides granular insights into driving patterns, enabling usage-based insurance models. Health insurance. Claims data helps identify trends in healthcare utilization and costs, informing underwriting guidelines that consider factors like chronic conditions, lifestyle behaviors, and preventative care measures. Commercial insurance. Businesses present complex risk profiles. Historical claims data allows underwriters to assess industry-specific risks, such as cybersecurity threats in the technology sector or supply chain vulnerabilities in manufacturing. Life insurance. Mortality studies and claims experience inform underwriting criteria related to age, health status, occupation, and hobbies. Advances in genomics and personalized medicine may further refine risk assessments. From an operational perspective, integrating claims data into underwriting requires collaboration among multiple departments, including underwriting, actuarial, IT, and compliance. Cross-functional teams ensure that models are technically sound, legally compliant, and aligned with business objectives. Investment in training and development is crucial to equip underwriters with the skills to interpret data analytics outputs and apply them effectively. Cultural change within organizations is also necessary. Embracing a data-driven culture involves shifting mindsets from reliance on intuition and traditional practices to evidence-based decision-making. Leadership plays a key role in championing this change, promoting the value of data analytics, and fostering an environment of continuous learning. Emerging technologies continue to shape the landscape. Artificial intelligence and machine learning enable predictive analytics that can anticipate future claims patterns. Natural language processing, NLP, allows for the analysis of unstructured data, such as claim adjuster notes or customer feedback, uncovering insights that may not be evident in structured datasets. Edge computing brings data processing closer to the source, reducing latency and enabling real-time analytics. In the context of global markets, insurers operating internationally must consider variations in regulatory environments, cultural norms, and risk exposures. Harmonizing underwriting guidelines across different jurisdictions requires careful consideration of local laws, market conditions, and claims experience. This complexity underscores the importance of flexible models and adaptable strategies. Educational institutions and research organizations contribute to advancing the field. Universities offer specialized programs in actuarial science, data analytics, and risk management. Research published in journals like the Journal of Actuarial Practice and Risk Analysis explores innovative methodologies and applications. Professional certifications, such as the Chartered Property Casualty Underwriter, CPCU designation, provide practitioners with advanced knowledge and recognition. In terms of challenges, data quality remains a critical concern. Inaccurate or incomplete claims data can lead to flawed models and misguided underwriting decisions. Data silos within organizations hinder the integration of information across departments. Overcoming these issues requires robust data governance, integration strategies, and a commitment to data stewardship. Furthermore, the ethical use of data necessitates adherence to principles of fairness, accountability, and transparency. Bias in data or models can perpetuate systemic inequalities. Organizations must implement measures to detect and mitigate bias, such as regular audits, bias correction algorithms, and diverse teams involved in model development. Regulatory developments continue to influence practices. Laws like the Insurance Distribution Directive, IDD, in the European Union emphasize consumer protection and transparency in insurance products. Compliance requires that underwriting criteria be justifiable and communicated clearly to policyholders. Regulatory sandboxes offer environments for insurers to test innovative approaches under regulatory supervision, fostering innovation while ensuring adherence to standards. Looking ahead, the convergence of technologies like artificial intelligence, blockchain, and quantum computing may revolutionize underwriting. Quantum computing holds the potential to solve complex optimization problems and process vast data sets at unprecedented speeds. While still in early stages, advancements in quantum algorithms could enhance risk modeling capabilities significantly. Moreover, societal trends such as climate change introduce new risk considerations. Insurers must integrate environmental data into underwriting criteria to assess risks related to natural disasters, transitioning industries, and regulatory changes aimed at sustainability. The Task Force on Climate-Related Financial Disclosures, TCFD, provides recommendations for reporting and managing climate-related risks, influencing underwriting practices. In summary, integrating historical claims insights into underwriting guidelines is a multifaceted endeavor that enhances risk assessment accuracy, supports fair pricing, and improves overall operational efficiency. It requires a combination of theoretical knowledge, practical skills, technological infrastructure, and ethical considerations. By effectively leveraging claims data, insurers can better understand risk profiles, tailor products to customer needs, and navigate the evolving landscape of the insurance industry. Analyzing past surety claims through detailed case studies provides invaluable insights into the complexities of suretyship and risk management. Surety bonds, rooted in ancient practices dating back to Mesopotamian times, serve as a tripartite agreement among the principal, obligé, and surety, ensuring the fulfillment of contractual obligations. Understanding the nuances of past claims not only illuminates the factors leading to defaults, but also equips stakeholders with actionable lessons to mitigate future risks. One illustrative case involves the construction of a major infrastructure project, wherein the principal, a construction company, defaulted on its obligations, leading to significant financial losses for the surety. The historical context of this scenario is set against the backdrop of an economic downturn, where tight credit conditions and reduced demand for construction services strained the financial health of many contractors. The theoretical framework applicable here includes the principles of risk assessment and surety underwriting, which emphasize the evaluation of a principal's financial stability, project management capabilities, and external economic factors. In this case, The principal had overextended its resources by taking on multiple large-scale projects simultaneously. The practical application of financial ratio analysis could have revealed red flags, such as declining liquidity ratios and increasing debt-to-equity ratios. The surety's failure to conduct thorough due diligence exemplifies a lapse in adhering to best practices in risk evaluation. Interdisciplinary connections emerge when considering organizational behavior theories, such as the agency theory, which highlights the conflicts of interest between the principal's management and the stakeholders. The management's aggressive expansion strategy, driven by personal incentives, overlooked the company's capacity constraints and market conditions. Contemporary debates in the surety industry focus on the adequacy of traditional underwriting methods in capturing the dynamic nature of modern construction projects. Critics argue that reliance on historical financial statements may not sufficiently predict future performance, especially in volatile economic environments. This case underscores the need for incorporating real-time data analytics and forward-looking indicators into the underwriting process. Studies published in the Journal of Construction Engineering and Management suggest that predictive modeling, utilizing project-specific variables such as project complexity and geographic location, enhances risk assessment accuracy. Another significant case study involves a technology startup that defaulted on a performance bond related to software development for a government agency. The historical context here reflects the rapid evolution of the technology sector, where startups often operate with untested business models and products. The theoretical framework of innovation diffusion theory, as proposed by Everett Rogers, can be applied to understand the adoption challenges of new technologies. The surety underestimated the technological risks and over-relied on the principal's projected growth and market potential. Practical lessons from this scenario emphasize the importance of domain-specific expertise in underwriting. The surety lacked sufficient understanding of software development life cycles, intellectual property issues, and the regulatory landscape governing technology contracts. Interdisciplinary connections to information systems theory and project management methodologies, such as Agile and Scrum, reveal that traditional risk assessment tools may not adequately capture the iterative and uncertain nature of technology projects. The inclusion of technical experts in the underwriting process could have provided deeper insights into potential pitfalls. Contemporary debates center on the role of sureties in emerging industries and the necessity of adapting underwriting criteria to sector-specific risks. The integration of qualitative assessments, such as evaluating the principal's technological competencies and innovation strategies, complements quantitative financial analyses. Research in the International Journal of Project Management supports the adoption of multi-criteria decision-making models that incorporate both financial and non-financial factors in risk evaluation. A third case study examines the default of a subcontractor on a large-scale public works project, leading to delays and additional costs. The historical context involves the increasing complexity of supply chains and the prevalence of subcontracting in construction. The theoretical framework of supply chain risk management highlights the vulnerabilities introduced by multiple tiers of contractors. The principal's failure to monitor the subcontractor's performance and financial health contributed to the default. Practical methods to mitigate such risks include implementing rigorous subcontractor pre-qualification processes, ongoing performance monitoring, and contractual provisions that allow for intervention in case of underperformance. Interdisciplinary connections to legal studies reveal the importance of clear contractual terms and conditions, as well as the enforcement mechanisms available to principals and sureties. The use of performance metrics and key performance indicators, KPIs, aligns with management accounting practices, providing quantitative measures of subcontractor performance. Contemporary debates focus on the allocation of risk among parties in complex projects. The concept of risk transfer versus risk sharing is explored in project management literature. Some argue for collaborative approaches, such as integrated project delivery methods, which promote joint responsibility and open communication among all stakeholders. This case highlights the limitations of traditional contractual structures in managing systemic risks inherent in complex projects. Another notable case involves a default triggered by regulatory noncompliance, where a principal failed to adhere to environmental regulations, resulting in project suspension and financial penalties. The historical context reflects the growing emphasis on environmental sustainability and regulatory oversight. The theoretical framework of corporate social responsibility, CSR, and stakeholder theory underscores the importance of ethical conduct and compliance in business operations. Practically, the surety could have assessed the principal's compliance history and environmental management practices. Incorporating environmental, social, and governance (ESG) criteria into underwriting guidelines aligns with emerging trends in sustainable finance. Interdisciplinary connections to environmental science and public policy provide insights into the regulatory landscape and the potential impacts of non-compliance. Studies in the Journal of Business Ethics advocate for the integration of ethical considerations into risk assessment processes. Contemporary debates revolve around the extent to which sureties should factor ESG considerations into their underwriting decisions. While some argue that focusing on financial metrics suffices, others contend that ESG factors are integral to long-term risk assessment. Regulatory developments, such as mandatory ESG disclosures in certain jurisdictions, influence this discourse. The case demonstrates the tangible financial consequences of neglecting regulatory compliance, reinforcing the argument for comprehensive risk evaluation. An additional case study pertains to a principal's default due to cybersecurity breaches, which compromised project data and led to contractual breaches. The historical context highlights the increasing prevalence of cyber threats in the digital age. The theoretical framework of information security risk management emphasizes the identification, assessment, and mitigation of cyber risks. The principal's inadequate cybersecurity measures exposed vulnerabilities that were exploited by malicious actors. Practically, the surety could have evaluated the principal's cybersecurity posture, including policies, technologies, and employee training programs. Cybersecurity assessments, such as vulnerability scans and penetration testing, provide actionable insights into potential weaknesses. Interdisciplinary connections to computer science and cybersecurity law offer a deeper understanding of the technical and legal aspects of cyber risks. The cybersecurity framework developed by the National Institute of Standards and Technology, NIST, serves as a guideline for assessing and enhancing cybersecurity capabilities. Contemporary debates focus on the role of sureties in addressing cyber risks and whether traditional underwriting practices are sufficient in the face of evolving threats. The integration of cyber risk assessments into underwriting criteria is advocated by industry experts. However, challenges include the rapidly changing nature of cyber threats and the technical expertise required to evaluate them effectively. Collaborative efforts between insurers, cybersecurity professionals, and policymakers are suggested to develop standardized assessment tools. Analyzing these case studies collectively reveals common themes and actionable lessons. A recurring issue is the underestimation of non-financial risks, such as operational, technological, and compliance risks. Traditional financial analysis, while essential, may not capture the full spectrum of potential vulnerabilities. Therefore, a multidimensional approach to risk assessment is necessary, incorporating qualitative evaluations and expert judgments. Another lesson is the importance of ongoing monitoring and proactive engagement. Risks can evolve over the life cycle of a project or contract, necessitating continuous oversight. Early warning systems, informed by key risk indicators, KRIs, enable timely interventions. Interdisciplinary connections to systems, theory, and dynamic risk management support the development of adaptive strategies that respond to changing conditions. The role of communication and information sharing emerges as critical. Effective communication among principals, obligees, and sureties fosters transparency and trust. Breakdowns in communication can obscure emerging risks and hinder collaborative problem-solving. Theoretical perspectives from organizational communication highlight the mechanisms for enhancing information flow and coordination among stakeholders. Furthermore, the integration of technology and risk assessment processes offers significant advantages. Advanced analytics, machine learning, and artificial intelligence can process vast amounts of data to identify patterns and predict potential defaults. Predictive analytics models, as discussed in the Journal of Risk and Insurance, have shown efficacy in enhancing underwriting accuracy. However, the reliance on technology must be balanced with human expertise to interpret results and make informed decisions. Ethical considerations permeate the analysis of past surety claims. The ethical conduct of principals, including honesty, integrity, and accountability, significantly influences project outcomes. Ethical lapses, such as fraud or negligence, can lead to defaults and legal repercussions. Incorporating ethical assessments into risk evaluation aligns with deontological ethical theories, which emphasize duty and moral obligations. Contemporary debates address the challenges of globalization and cross-border projects. Differences in legal systems, cultural norms, and business practices introduce additional risks. The case studies highlight the need for sureties to understand the local context and to adapt their risk assessment models accordingly. International standards, such as the International Financial Reporting Standards, IFRS, and the Uniform Customs and Practice for Documentary Credits, UCP 600, provide frameworks for harmonizing practices across jurisdictions. Speculative insights consider the potential impact of emerging technologies like blockchain and smart contracts on suretyship. Blockchain's immutable ledger could enhance transparency and reduce fraud, while smart contracts could automate performance obligations and trigger surety actions based on predefined conditions. However, legal and regulatory adaptations would be necessary to accommodate these technologies within the existing surety framework. Moreover, the rise of environmental and social governance as critical factors in business operations suggests that future surety claims may increasingly relate to ESG issues. Climate change, social responsibility, and corporate governance practices are becoming central to risk assessments. The integration of ESG metrics into underwriting and monitoring processes could preempt claims related to these areas. In synthesizing the actionable lessons from these case studies, several key strategies emerge for sureties. 1. Comprehensive risk assessment. Expand risk evaluation beyond financial metrics to include operational, technological, compliance, and ethical factors. Utilize multidisciplinary teams with expertise in relevant domains. 2. Continuous monitoring. Implement ongoing oversight mechanisms to detect changes in risk profiles promptly. Use data analytics and real-time reporting to stay informed of developments. 3. Technological integration. Leverage advanced analytics, AI, and cybersecurity tools to enhance risk detection and assessment capabilities. Stay abreast of technological advancements that could impact surety practices. 4. Stakeholder collaboration. Foster open communication and collaborative relationships with principals and obligees. Establish protocols for information sharing and joint risk management efforts. 5. Regulatory compliance and adaptation. Stay informed of legal and regulatory changes that affect suretyship. Ensure that practices comply with current laws and anticipate future regulatory trends. 6. Ethical frameworks. Embed ethical considerations into risk assessment and decision-making processes. Promote ethical behavior among principals through contractual obligations and monitoring. 7. Global perspective. Develop an understanding of international risks and practices for cross-border projects. Adapt risk assessment models to account for local conditions and legal requirements. 8. Education and training. Invest in ongoing education for underwriters, risk managers, and other professionals involved in suretyship. Stay informed of industry developments and emerging best practices. Interdisciplinary connections reinforce these strategies. Insights from economics, finance, law, psychology, technology, and environmental studies contribute to a holistic understanding of risks and mitigation approaches. Collaborative research and knowledge sharing among academia, industry, and government agencies enhance the collective capacity to address complex challenges in suretyship. Contemporary debates continue to shape the discourse on surety claims and risk management. Discussions on the balance between technological innovation and human judgment, the ethical use of data, and the evolving nature of risks ensure that the industry remains dynamic and responsive. By critically analyzing past claims and extracting actionable lessons, sureties can strengthen their practices, contribute to the stability of markets, and support the successful completion of projects critical to economic and social development. Predictive modeling for future claims represents a transformative approach in the insurance industry, leveraging advanced analytics to forecast potential claims and adjust underwriting practices accordingly. Historically, the roots of predictive modeling in insurance can be traced back to the early 17th century, with the development of probability theory by mathematicians such as Blaise Pascal and Pierre de Fermat. These foundational concepts enabled the quantification of risk and laid the groundwork for actuarial science. Over the centuries, the evolution of statistical methods and computational technologies has significantly enhanced the ability to analyze large datasets, leading to more sophisticated models that can predict insurance claims with greater accuracy. The theoretical frameworks underpinning predictive modeling in insurance are multifaceted, encompassing probability theory, statistics, machine learning, and actuarial science. Probability theory provides the mathematical basis for assessing the likelihood of future events, which is essential for estimating potential claims. Statistical methods, such as regression analysis and time series forecasting, enable the identification of patterns and relationships within historical claims data. Actuarial science integrates these statistical techniques with financial theory to evaluate risk and uncertainty in insurance contexts. Machine learning, a subset of artificial intelligence, introduces algorithms capable of learning from data to improve prediction accuracy over time. Techniques such as decision trees, neural networks, and ensemble methods are employed to capture complex, nonlinear relationships in the data.